You guys ready?
Let's do it.
I'm going to start out. I am your moderator, Bart Stephens. I'm the founder of Blockchain Capital. We started our firm 14 years ago and have made over 180 investments across 9 funds. And I'm honored and privileged to be joined by some of the best operators here on stage. For disclosure purposes, I am investor of 3 of the 4 at the seed round. But I want to start by thanking Senator Cynthia Lummis in the state of Wyoming. They've been leaders from the get-go. They've pushed a really tough ball up the hill, so just some acknowledgments. Thank you to the Kraken guys and Anthony for always a wonderful conference here in Jackson Hole. So we'll start out with some quick intros. That was mine. We'll go down to the end. Chad, you're up.
My name is Chad Cascarilla. I'm the co-founder and CEO of Paxos. We are a crypto and blockchain infrastructure company. We do wallet infrastructure, and we issue stablecoins, gold stablecoins, dollar stablecoins, and soon other assets as well.
I'm Carlos Domingo. I'm the co-founder and CEO of Securitize. We are the leading tokenization platform of real assets. So we basically work with asset managers and issuers of securities to move their securities on chain through the tokenization process and then make them more useful and easier to consume.
Hi, I'm Farooq Malik. I'm the founder and CEO at Rain. We're a stablecoin payments infrastructure company focused on authorization, settlement, and reconciliation technology for any type of payment, for any type of token at scale. And it's great to be here.
My name is Mike Belshe. I'm co-founder and CEO of BitGo. We are a digital asset infrastructure company. We've been doing this since about 2013. And we build all up and down the stack from wallets to custody to financial services.
Yeah, so let's get into the stack a little bit. Stablecoins, so what's called Bitcoin, its own animal. It's obviously the biggest, the oldest, the largest. Most people think of it as something akin to digital gold, not a payment system. The underlying infrastructure that Satoshi gave to the world, like many technologies, was pivoted by many of the entrepreneurs on stage for payments using dollars. The whole world wants dollars. It's the world's reserve currency. And so there's stablecoin issuers, there's stablecoin orchestrators, there's a stablecoin law, Genius, which is a nice update since the 1930s. Our securities laws are written in the horse and buggy era for a Tesla world, but we've made some progress, and hopefully after the last couple panels, we got some great news coming. So just going down the road, maybe you guys could talk about where you sit in the stack, how stablecoins are useful to your business, your customers, and the value that you see creating for the overall ecosystem.
All right, sure. So look, I mean, digital money is programmable. It's orchestratable. You can put it into all kinds of systems super easily. I'll give a story all the way back to the beginning of BitGo. Back, 2013, 2014, we started invoicing our first clients. This is pre, stablecoins. And we always give our clients a choice. Do you want to pay in dollars, at the end of the month, or do you want to pay in Bitcoin? And we did about 50% of our business in the US, 50% outside the US. And within about 3 billing cycles, almost every single one of our international clients switched from dollars to Bitcoin. Everybody initially wants to pay in dollars. Nobody wants to give up their Bitcoin, especially back then. But they would all switch to Bitcoin simply because the rails of moving money, especially internationally, so painful. So that was maybe a more extreme example where you've got like larger amounts of money, I guess business money that's moving and is international in an early time with Bitcoin companies. But the friction of moving money is there, and we all see it. Our banks run very poorly. You've all had an experience trying to wire money from somewhere to somewhere. Bank charges you $100 and can't even get the wire through. What kind of business is that? You fail and you still charge the client. All right, so stablecoins are absolutely going to become the dominant payment mechanism in digital assets. At BitGo, we built this thing, we call it the Mint Burn Center. At this point, you can mint, you can burn at almost no cost any of the stablecoins, convert them in all kinds of different ways. our clients have a real issue. They need to be able to get kind of in and out of these things. The entire industry is building liquidity, and liquidity is key. Any asset you're going to hold that you're going to use as a payment rail, you need to know that you can get to and from wherever else you need to be. So it's had a major impact. It's an impact on trading. Of course, we've got the Mint Burn Center. It'll continue on payments. I think the next step is getting micropayments going, agentic payments going. All of these things are happening, and it's going to come really fast.
Yeah, kind of expanding on what Mike was saying, right? I think our viewpoint is that at the end of the day, whether it's tokenized money, digital money, stable coins, tokenized deposits, CBDC, whatever you want to call it, the reality is that it'll be many of these things in different markets around the world as various regulations come in and there's different incentives for various parties. Our viewpoint is that to an individual, consumer, or a business, does it matter? Should it matter? Like no one here really cares or knows what banking core their partner bank or their bank that they use on a daily basis works on top of. They also don't know, hey, which bill you have in your pocket, like what Federal Reserve stamp is on it. It really doesn't matter. And so our viewpoint is that like ultimately, the whole purpose of money is utility. And Rain has been working on building the utility layer for all money, whether it's to bridge it backwards to interacting with fiat rails, whether it's moving ahead to providing programmability for any type of money, for any type of purchase or transaction across any blockchain, for any token, for any user. And that's where we think a lot of this money is going to go. I think ultimately the world is going to continue getting a little bit more complicated, where there's a lot of different tokens, a lot of different types of blockchains that are supported, a lot of different things that people will want the tokens themselves to do. But the reality is that the things that we do as a business or the things that I do as a consumer, those things are broadly not changing, right? Like I'm buying food and drinks, I'm buying airplane tickets, my business is paying vendors, we're paying payroll. Those things are mostly going to stay the same. And so ultimately, how do we kind of build better products and services for the things that people actually use money for? That's where we are really excited about the applicability of tokenized money and where we think that the sort of real innovation is going to continue coming from.
So in our case, we focus on tokenization of real assets, but focusing on securities. So we tokenize things like treasuries, bonds, equities, high-yield products, credit, etc. And when you deal with securities, every single transaction involves also dealing with dollars as the counterparty, right? Whether you need to trade, a security against a dollar, whether you need to, pay a dividend, whether you need to invest on a fund, etc. So the whole promise of why tokenization of securities or tokenized securities are superior is because on the same ledger technology, you can actually represent with the same underlying technology a dollar and a security. So stablecoin is a tokenized dollar and tokenized securities are the counterparty. So everything we do when we actually do it in conjunction with the stablecoins, it becomes better. We can do instant investment on a fund and receive stablecoins and mint securities instantly, so your funds are deployed instantly. We can do instant settlement on chain by swapping stablecoins against, let's say, equities. We can distribute dividends in a very efficient way by just distributing stablecoins to wallets, knowing in real time what the balances are, etc. So the whole idea of tokenized securities is predicated on the fact that you have also tokenized dollars alongside. So when I started the business, I think Tether was the only one that existed, and it was like $1 billion. USDC actually launched in September 2018. So the fact that now stable coins have scale and have like around $200 billion is something that benefits also our side of the business because we can then use tokenized securities in a better way.
So I think the important thing to recognize with stablecoins is really solving two things. One is a better rail, 24/7, instantaneous, programmable, cheap, et cetera. And then you have an account structure. And an account structure means that someone can hold it without needing an intermediary. And that's what you get with a stablecoin that is so powerful. Just upgrading the rails, that's really great, that matters. But where you're really seeing, I think, the innovation happen is where you can add the account structure element into this as well. And so for us at Paxos, we have a wallet business that powers crypto trading for firms like Charles Schwab or PayPal and Venmo and Interactive Brokers. There's like 25 million wallets that are built off of us that do trading or payment solutions like Stripe uses us, MasterCard. and a number of other firms. And that's the wallet business, and we're agnostic. We'll allow any stablecoin or any type of token to come into our wallets because people have all kinds of different use cases. We also issue white label stablecoins. So it's not our stablecoin, it's our customers, so we issue the PayPal stablecoin. It's PayPal's name on it. We're doing everything underneath the hood. We issue something called the Global Dollar for the Global Dollar Network. It's like 170 firms, including Kraken and Robinhood and a whole host of others, OKX. Again, it's not Paxos's, it's others. And there's lots of other firms that come along and they want to issue their own white label or consortiums that want to do it. There's only going to be a couple global rails, so you probably don't want to have hundreds of stable coins that are trying to be global rails, but you could have hundreds of stable coins that are creating some effect for a community, for a chain, for a set of users that allows you to have a different experience. And so that could potentially exist, just like there's many different types of rewards cards and prepaid debit cards, but there's really only a couple networks. It's a rough analogy. But I think the important thing is that you're really changing the way money operates by having an ability to control an account when you didn't before, simply by having a wallet on your phone. And that's an enormous democratizing access for the US dollar and for the whole financial system. And as you get into agentic commerce, this will become even more and more important because you're going to want to be able to create units and accounts that are fully programmable because you're going to have actors that are operating as programs. I think that all just makes sense. Now, we're still at very early stages of this, so I think we can maybe get a little overblown. Really, most of crypto and stablecoins are tied together. Stablecoins are down maybe 5% or something from the October peak in the crypto market. And it's not that other uses of stablecoins aren't growing a lot. I think they are. It's just that you're coming off of a low base. And so whether it's agentic or other use cases, they're growing very quickly, but small, which is why you've seen this pullback actually in stablecoin market cap. Not because I don't think there's more adoption happening. I think there's actually way more adoption happening. It's just the stock is shrinking because the main place that you use stablecoins is in the on-chain economy. And what's the main on-chain economy used for? Crypto-related activity. And so that's in a crypto winter. You're going to have some pullbacks in the stock, but not, I think, in the flow.
We'll get to stocks in a second, and I think you're right on that. I think this is a temporary blip. A lot of stablecoin usage is outside of the United States. Most of us take for granted the old but usable financial infrastructure and rule of law we have here. But if you are unfortunate enough to live in a country with unsound monetary and fiscal policy, you want dollars so your life savings don't get inflated away. So there's lots of cool uses. There's lots of great approaches. Maybe a question for Mike, and then I'll follow up with Carlos. As two new, freshly public IPO'd CEOs, tell us about the experience versus being a private company, what it's like.
I get this question a lot. We went public in late January, earlier this year. And the reason we did that is because, frankly, the next frontier of folks that are coming in digital assets, we've got every major firm from BlackRock to Fidelity to now the DTCC itself. All these firms are used to working with pretty large, well-established, known, mostly public companies as their counterparties. So we wanted to join that so you can have full inspection of everything that we do. We put that out on a quarterly basis. All right, so look, the experience is what you would expect. I mean, the first thing that has to happen is actually migrating over to having books and records and all of your audits together is work for any company that's going public. Interestingly, and I met with Paul Atkins like a month and a half ago. I said, hey, thanks for putting us on the Fortune 500 list. And he says, huh? And, like BitGo, I guess I'm actually not supposed to say what our net revenue is, believe it or not, due to weird SEC things. But we end up having to account gross. So we do, $16 billion in revenue or something like that, puts us around 270 on the Fortune 500 list. So proud of that. One of the largest revenue generating companies in America, I suppose. But this is an accounting blip. that's caused by the IPO process, because I certainly never measured BitGo's business that way. All right, so anyway, you got to go through a bunch of things like that. The initial part is not very different. Then you do have a cadence, and I think for crypto companies, we're required, of course, to report every 90 days on the financial status of the company, but we're living in cycles that don't neatly fit within 90-day periods. You know, whether you're talking about, you know, how rewards come on chain from, you know, staking providers, how the market is moving. So we have to figure out how to navigate that. And then one of the things we've done, look at the core of our business. You know, custody is kind of where things start, and then we build off of that. We want to make sure that people can see that the custody is growing. But if you look at digital asset prices going like this, you know, it's difficult to show that always up and to the right. So we've had to figure out how do you tell the market how we performed versus how the market's performing. So we use this thing called normalized assets on platform. Take any price, fix the price at the beginning of the period, the end of the period, doesn't matter, and then you can see, you know, the growth is there, and you can kind of differentiate BitGo's performance from the rest of the market. Anyway, education to be done there. The one exciting thing about this is there's all the investors in the IPO process, and when you're talking about like the big long-only funds that come and invest in IPOs typically, they have very little exposure to what is digital assets, what is crypto. They've got kind of some rough things. Had to go back to talking about like what is a private key, some of the basics that we used to talk about back in 2015, 2016. This education is happening now. They also bring with them some new types of risks they're worried about. I'm not too worried about the quantum threat, but all of them are, right? They're thinking about how do they allocate, you know, hundreds of millions and billions of dollars, and they're like, can we trust this asset class if quantum's isn't it just gonna get all hacked? Of course, that's not true, so don't be afraid of that. But we have to now answer those questions for those types of investors. What's that?
So do they.
Yes.
Carlos.
So we just went public recently in July, so I'm still a freshman compared to Mike. But no, the reasons are very much what Mike said. We also our counterparties and our customers are very large corporations like BlackRock, BNY, Apollo. Today we announced Neuberger Berman, etc. So being publicly traded means they know your financials, they know you have money in the balance sheet, you're not going to disappear. And they, you know, have more confidence towards using your services, because at the end of the day, for them, it's very important to know that you're going to be in business within the next, you know, foreseeable future, because they're putting their assets in our hands, right? And the companies that traditionally tend to use are very, very large corporations, like here is BNY or State Street, etc. The other thing is, I think that, you know, crypto, especially now that we're going through a crypto winter, is probably going to consolidate. So having a strong balance sheet and liquid equity helps, you know, looking at opportunities out there, which we are, you know, actively doing. And then I think the downside is that, as Mike said, there's, you know, small companies have volatility in earnings. It depends on market conditions. So you're being judged every single day about what your company does. And, you know, one day you announce something that is not very well received and you go down, and the other day you announce something positive and you go up. And you have to live with that and not be obsessed about it, and look at the long-term opportunity, which in our case of tokenization, it's enormous, because we're just scratching the surface. I think there's like $38 billion or something of tokenized assets, and they could be potentially trillions of dollars, right? So, you know, not looking at the day-to-day performance, but keeping an eye on the long term, I think is the most important thing.
Yeah. And I read this morning you just inked a deal with Neuberger Berman, so congratulations to that.
Good. Yes. So we presented actually last week at our earnings announcement that one of our strategies is to basically provide a portfolio of yield-bearing assets, which they particularly bond well with what crypto people are looking at, which are looking at generating yield. They're creating earnings accounts where they can deposit their stable coins and earn a yield in a safe way. They can be used as collateral for DeFi, etc. And we had basically started with treasuries with BlackRock, which has been very successful. On the opposite spectrum of the risk duration curve, we have private credit with Apollo and Hamilton Lane, and we were kind of filling the gaps in between. So at the beginning of this year, we released a AAA CLO product with BNY that has more or less 100 plus basis points more than treasuries. And then today we announced another product with Neuberger Berman, who is somewhere in between AAA CLOs and private credit, but it's liquid. It has T+1 liquidity, which is very important to interact with the crypto ecosystem. So all these projects take very long time. Like, people don't realize the amount of work behind convincing a very traditionally actually employee-owned company like Neuberger Berman to come on chain. But, you know, here we are, continue making progress.
Yeah, and I think a lot of these financial institutions, and I've talked to all of them over 14 years, they're waiting to be told the rules of the road. we are been waiting to tell the rules of the road. Can we drive the crypto car 6 kilometers an hour, 60 kilometers an hour? If you want us to drive it in reverse, we'll do that too. So it is a myth that the crypto industry is the Wild West. We just want to know the rules of the road, and there's great work being done at the CFTC and the SEC. You've heard from earlier speakers about near-term events going on, and maybe a legislative window that is very tight for the second of 2 major crypto bills clarity. We'll see if that happens. In absence of that, we've got very forward-thinking good news coming that will help entrepreneurs and investors alike in traditional financial institutions get more and more comfortable with this emerging technology. Farooq, maybe a fastball to you. You had a pretty spicy post recently. You got a lot of feedback back and forth on my crypto Twitter feed. Maybe you could break that down and explain your side a little bit to maybe those that don't live on crypto Twitter.
Yeah, you're talking about the stablecoin swipe? Yeah, look, I think there's a lot of people that have viewpoints on how the financial system works. And they feel that because it works for the biggest companies, the biggest banks in the world, means that nothing is broken, there's no opportunity to fix. Ultimately, the participants of the financial system are quite diverse. They're spread around the world. They're various sizes. There's banks in the world that are 2 or 3 people that are operating a financial institution. Some of those banks are here in the United States. And so ultimately, right, if you think about what happens when you upgrade financial infrastructure, it doesn't have to be digital assets upgrading the system. It can be even traditional financial upgrades, right? If you look at what's been happening with FedNow or RTP, a lot of financial institutions are stuck. They're stuck on the older way. And they're stuck because they don't have access to expertise. They don't have access to resources. They don't have access to people that are there to help them reach the future. They're stuck with partners that currently extract rents to even give them the various things that are quite obsolete that they currently have. And so if you think about what's possible when you start changing the dynamic of inter-party settlement, you start changing the dynamic of allowing smaller financial institutions to leapfrog antiquated technology and move to a newer settlement modality, even on the back end, you change nothing else. That has the potential to really supercharge an institution that was dying and make them into an institution that can not only survive, but now thrive. And so whenever we post these types of things, we like to post stuff about what do we actually see in practice, right? Rain today, we power, over 100 different programs today. We power billions of dollars of payment volume around the world for end users in dozens of markets around the world. We also have been able to operate our business, right, versus the traditional enablement model at about a 90% more efficient working capital basis than was previously possible. And this is simply because we don't have to be bound by settlement modalities driven by working hours or by working days or by weekends or holidays. We can settle 7 days a week. We can settle with our customers 24 hours a day. We don't end up having to take risk on a counterparty. And if you look at, when you look at the world, when you look at when most banks collapse and when most counterparties collapse, they generally collapse after business hours on Friday. That is not accidental. That's because somebody's forcing you to take that counterparty risk over the weekend. And so in a 24-hour marketplace that has 24-hour money, that's a choice. You no longer can be forced into that position. And that is a meaningful difference between what is qualitatively better versus what is qualitatively the same. And so back to kind of what folks have been saying on Twitter, there's a lot of people that think, okay, well, JP Morgan doesn't have to post collateral. They don't have to do these types of things. Yeah, because they're a publicly traded company. They have ratings from the ratings agencies. There's a qualitative value to the debt that you are allowing JP Morgan to accrue over a weekend or over a month or a quarter or a year or 5 years, and there's a price attached to that. The vast majority of people that are participating in the financial sector are not rated by S&P or Moody's. They're not creditworthy in the traditional sense. They don't have anybody waiting to just waive their collateral obligations to them. And so there's a really interesting thing happening, which is the conversation is being had, right? I think when you see people feel very strongly about something that they read on Twitter and feel so strongly to then post a rebuttal and then continue engaging with it, I think that's good, right? I think diversity of opinion is good. I don't think that anybody's making a ad hominem attack against us or what we're saying. I think ultimately there's differences of opinion. I think our viewpoint is that most differences of opinion are driven by a misunderstanding of the ground realities.
Yeah, I want to touch on something that you guys each individually touched on and was on my planned talk. We don't have tons of time to get into it, but Satoshi's white paper, the subtitle was a peer-to-peer electronic transfer system. And it's possible he was not talking about 8 billion human beings on this planet. It could be trillions and trillions of agents that have a wallet that are paying 6 cents for API calls. We've invested in some of these companies. How do you guys see the intersection of crypto and AI? I see it as complementary, but at the same time, it sucked all the capital and oxygen out of the room for allocators and investors worldwide, paying trillions of dollars of valuations. So I'd love to just go down the line and get you guys' thoughts on that exciting intersection, or if you disagree, love to hear that too, and maybe what you guys have cooking in terms of micropayments and how you see machine-to-machine payments.
Look, crypto was born for AI. I mean, yeah, of course AI is going to be using a digital money. They're not going to be using a non-digital money. Maybe we have to worry about the robots creating their own money and excluding us from it. Maybe that might be the biggest worry for the long term. But look, the types of protections that you put in play in order to secure wallets, and we pioneered multi-sig a long time ago, but we do, how do you eliminate single points of failure? How do you share those across multiple parties? How do you make sure that your company can have somebody leave and you still have access to the money? When you throw a robot into the mix, the robot is actually like a human. It's like another person on that wallet that has some set of permissions. So actually it fits right in with what we've been doing for a long time. So I think there's a lot of excitement about what's coming with agentic payments. This has actually already been built and is ready to go. There's a little bit, I think, to be done on the identity side, which is moving, I think, a little bit more thanks to AI than it has. We've been talking about identity for a long time. But for the most part, I mean, of course, this is just perfectly ready. I think anybody that is not excited about crypto but is excited about AI, they're kind of forgetting that these two things are going to go hand in hand.
Yeah.
So it's a very exciting time all around.
Yeah, it creates abundance, and crypto is really good at securing scarcity, chain of custody, and identity. Maybe your take?
Yeah, earlier today we announced our Agentic Payment Alliance. It is a partnership with Rain and a number of other institutions around the world that are focusing on creating universal standards for agentic payments. We're working with folks like Visa, we're working with MasterCard, we're working with even folks like Fiserv to start building more of an interoperability layer between various initiatives. If you look at any new industry, the beginning is folks trying to toil away alone to build their own standard. And then generally, to make sure adoption happens, you have to connect it to how people already transact. And that's generally over existing payment modalities. And then the next phase is, okay, how do you bridge the gap and kind of close the loop? And all of that needs to have standards that everybody can iterate against. They can always integrate, they can work together. Everybody can build their own version of that. They can build their own ecosystem on top of it. But ultimately, I think setting standards is very important. So that's what Rain has been focusing a lot on, is how do we bring folks together to establish sort of the base layer for what agentic payments can look like, both for crypto native payments, digitally native payments, but also for traditional connectivity.
And my analogy of this for the parents in the room, if you've used the Greenlight app for your kids, you kind of meter the money out. They can't drain your whole brokerage account. So I think we're going to see similar behavior with some adult supervision over your various agents doing things on your behalf while you sleep. Carlos, I don't know if this is on your game plan or not, but
yeah, in our case, where we see the opportunities in agentic trading, right? So if you think about what a lot of the role of a portfolio manager, depending on what are you managing, it is rebalancing portfolios, right? Like you have a number of reserve assets, and you're moving from treasuries into bonds, and from bonds back to treasuries, etc., just to make sure that you are always in the right kind of risk-reward, threshold that you want to be. The same thing with, equities, et cetera. And that, when the underlying assets are programmable and they move 24/7 and can be, you can move them through, APIs, et cetera, that's when agentic trading becomes a reality, right? So you need the AI side, as Mike said, they're complementary, right? Because if you have an AI agent that can trade, but you don't have the underlying assets that can actually be moved programmatically, then you only have one side of the story. So I do think that, crypto, and in our case, tokenization of real assets is extremely complementary with AI.
So, I think I talked a little bit about how important agentic commerce will be, and I think it's inevitable that it's going to be a critical feature and use case of crypto and blockchain, because you need to have some way of creating a source of truth. And you need that source of truth to be digital and composable, but it has to exist in a way that users can use. And now you have a new type of user, which is an agent. And there's not going to be a few agents, there's going to be lots of agents, and they are going to probably be the main actors that are moving funds around. And so, well, what are they going to speak? They're going to speak in some type of digitized money, which I think is likely stablecoins. But it could be other things too, and they're going to be trading and being able to move around all kinds of portfolios. Today, you could just download. You could probably go to OpenClaw and you could just use a MetaMask wallet, and you could give it like $20 and say, hey, go ahead and come up with a return profile that I want. I don't know, 20%, and go make investments. And by the way, it's not going to do a very good job. But the whole point is you can still do that. You can already do that. And so what is it going to be like in 3 years or 4 years or 5 years? I think the direction of travel is pretty obvious, but it's not going to be exactly linear. Wherever you're at on the S-curve, it's very hard to extrapolate. And I don't think we're quite at a place that I would call maturity by any means.
No, early innings for sure. For disclosure, we invested in Sam Altman's proof of identity company called WorldCoin, and I teased him that he invented the cure and the disease at the same time. We're not going to know if we're talking to agents or people behind the keyboards in the very near future. We have less than a minute left, and I'd like to just make a shout out to and express some gratitude to all the policy ninjas in the room, the people that have been working tirelessly for years to educate, to lobby, to organize. Our industry is not going to be uninvented. It is here to stay. All we want is a level playing field. And it's taken a lot of blood, sweat, tears, organization, and dollars. And so thank you to all those, including everyone on the stage who's made many trips to DC. Because without organization, we had a near-death experience under Gensler, but it won't happen again. And we've got tailwinds, not headwinds. And maybe we'll wrap it with that. Thank you, guys.
Thank you.